This video covers the last 5 tasks on the second AAT sample assessment for personal tax. So 3 on capital gains tax and 2 on inheritance tax. Okay, so starting with task 9. Jim made a number of disposals of capital assets during 2021, detailed in the table below. Calculate the amount chargeable to capital gains tax. Enter 0 whole pounds only. Right. House. 30th of May. Jim sold his house, which was his main residence. Right, so I'm thinking private residence relief. No capital gains tax. He owned the house for 100 months, but bought a new apartment 6 months before he sold the house. The apartment became his main residence as soon as he bought it. So you can only have one principal residence at a time. So at that point, the house would no longer have been his main residence. However, there's the 9 months at the end for whatever reason rule for deemed occupancy. So the house costed, so although the apartment has become his main residence, it was within the last 9 months. So therefore, there would still be no capital gains tax on the house, on the sale of the house. Right, next one, car. I almost don't need to read the question because I know that cars are exempt. Jim sold his car, about to receive a company car, blah, blah, blah. Yeah, it's a car. Even if it was a vintage car, it would still be exempt. Just a car, however, not a vehicle. A car is exempt. Right, painting. Jim bought a watercolour at an auction for 4,000. He paid auctioneer fees. He paid 500 to restore it and sold it for 8,500. Okay, so I've got a chattel straddle over the 6,000. So I need to figure out which one it is. So the cost is lower than the proceeds. So that's going to be my 5/3 rule. So the 5/3 rule says you work it out normally first of all. So I'm going to say 8,500 minus 4,000. 2% auctioneer's fees on that is 80, so minus 80 as part of the cost. And paying restoration fees is adding value to the thing, so that would count, so minus 500. All right, so 8,500, take away 4,000, take away 80, take away 500 is 3,920. Make a note of that. And then I have to check the 5/3 rule. So the 5/3 rule is 5/3 times the proceeds minus 6,000. So 8,500 take away 6,000 is 2,500. 2,500 times 5/3 is 4,166. So 4,166 is higher than 3,920. So I would stick with the normal calculation. All right, so remember with the 5/3 rule, you pick the lower because it's capped at the 5/3 rule. Right, antique table. Jim bought a table for 4,750 and sold it for 6,300. All right, it's another chattel straddle. A friend is not a connected person, so I don't need to worry about that. This is the same way round as the other one. The selling proceeds are over and the cost is under, so it's the 5/3 rule again. So working it out normally, 6,300 take away 4,750 gives me 1,550. I'll make a note of that. But then it's capped at the sales proceeds, 6,300 subtract 6,000. So that's just 300. 300 times 5 divided by 3 is 500. 500 is lower than 1550. So in this one, we would go with that capped figure. Right, land. Jim bought a small piece of land 5 years ago for 15,000. Jim sold the land to his father, connected person, for 4,000 when it was worth 17,500. So it's a connected person, so we replace the selling price with the market price. So 17,500, subtract the cost, there is a gain of 2,500. So not only has he sold the land very cheap to his dad, he's now also got to pay tax on 2,500. Right, Keris bought 20 acres of land for 45,900. During 2021, she sold 5 acres for 50,000 when the rest was valued at 400,000. Calculate the gain on the sale of the land. Right, so this is a partial disposal. So we start with the proceeds, 45,900. Oh no, sorry, that's what she bought it for. The proceeds is 50,000. And then to work out the cost, you have to use that, remember that A over A plus B thing? So to work out the cost, we're going to do 50,000 on the top, this is the fraction, divide by 50 plus 400 on the bottom. So that's obviously 450. So 50 divided by 450 is 0.1 reoccurring, not that that really matters, just keep it in your calculator. And then multiply that by the original cost of the whole lot. So that gives me 5,100 as the cost of the 5 acres that have been sold. Right, don't fall into the trap of doing 5 out of 20, right? You've got to do, it's the value of the bit you've sold over the value of the whole thing. Right, so the proceeds are 50,000, subtract the 5,100, which is the cost of the bit that we've sold, gives us an answer of 44,900. Okay, task 10. This is the share question where you have to do the share pool. So Mahesh holds shares in RSB Limited, has made a number of transactions. Here are the details. So we are going to be working out the gain on this final sale. So the first thing I'm just looking for is, was there any purchase on the same day? Was there any purchase within 30 days? That's obviously match 1 and 2. If there were any, there's not. So therefore, all of these are going to come out of the share pool. So here we have our 4-column grid. So remember, just head it up, date, detail, workings, number of shares, and cost in pounds. Right, so the first item is on the 13th of May 14. We've got a purchase. We have 1,000 shares at £10 each. So that's obviously a cost of £10,000. Usually this is left aligned, this first one, but never mind. 12th of December 15, there's a 1 for 10 bonus issue. So if I've got 1,000 at the moment and it's 1 for 10, that's obviously going to be another 100 shares, and a bonus issue means there is no cost. Do not fall into the trap of worrying about that £12. All right, ignore it. We then do a running total. So we've got 1,100 and we've got £10,000 worth. Right, 10th of September 16 coming up next. So 10th of September 16, we've got a sale. So a previous sale, 55 shares for £15 per share. Again, do not fall into the trap of worrying about that £15. We're selling 55 shares from our share pool. So our working is the total cost that we had in the share pool at that date, divide by the number of shares. That gives you the average price per share. And it's 55 shares, which of course are coming out of the pool. So let's show those in brackets. So we do that calculation, 10,000 divided by 1100 times 55. Oh, nice round number, 500. Don't forget to do your running total, your subtotal. Remember, this is not a question about getting to the right final answer. It is human mart, and they are expecting to see all of these steps shown. Right, what's next? 25th of April, we've got another purchase. of April 18, purchase. Right, so this is just another 595 shares. This time it is relevant because obviously this is the cost. That's why I think it's helpful to put cost in there. So as you remember, you're only dealing with costs and not market values and selling prices and all sorts. So 595 times 11 is 6545. Add that on, so running totals 1640, 16045. And then we come to our sale in question. So we're selling 330 shares. Again, the £20 doesn't matter yet. We will need that in a minute for this one because this is the one we need to work out the gain on. But right now it's not relevant. So what is relevant, same as we did before, 16045 divide by 1640 gives you the average cost per share. It's 330 that we're getting rid of. So if we do that calculation, 16045 divide by 1640, keep that in your calculator, times it by 330, you get 3228.56. I'll probably do normal rounding for that, but I don't think it matters too much. And remember, it's human mart as well. So what have we got? 1310 remaining number of shares, 12816. Label that balance carried forward. Right, so that's the share pool done. So then we just have to do the gain calculation. So I tend to use these two columns for shares and costs, but I don't suppose you have to do it like that. Proceeds. So we've got 330 shares. How much did we sell them for? 330 times £20 is 6,600. And the cost, and you could say that comes from the share pool. Remember, it could be the other matching rules as well, but we checked that at the beginning and they didn't apply. So all 330 coming out the share pool, and you can just copy that row. So 6,600 subtract 3,229 gives you a gain of 3,371. All right, so that's what you'd be looking to achieve there. Assume that Mahesh had bought a further 500 shares in RSB for £15 each on the 30th of April. Oh, right, so this is testing our knowledge of the matching. So the 30th, gosh, sorry, hang on. Woo. Why is it doing this? Come on. So it's stuck on there we go. The 30th of April is clearly within 30 days of the sale. So that would be match number 2. Remember, it's same day within the next 30 days or then the share pool. So if he had bought 500 on that day, these are the ones that would be matched for the sale. Remember, he's only selling 330. So it wants us to calculate the gain again on this information. So the proceeds would still be 6,600, exactly the same as here. But now the cost would be the next 30 days, and it would be, how many shares is he selling? 330 shares at £15. So 330 times 15 is 4,950. So the gain now would be 1,650. All right, because you're matching to these shares rather than from the pool as an average. Okay, so hopefully, like me, you'll quite like those questions. I think they're quite methodical. Right, so then we come to task 11, which is the last of our capital gains tax questions. So Precious's only income in 2021 is 45,500 from her employment. She made the following capital gains and losses. Complete the following sentences in respect of Precious's capital gains tax liability. So the total amount after allowances that Precious will pay capital gains tax on is, right, so they've been quite nice to us there by spelling out, don't forget the annual exempt amount, the allowance. So all I'm going to do is add up all the gains, 6,120 plus 12,600 plus 1,6210. I'm going to subtract the current year loss, the 14,600, which gives me 20,330. And then I'm going to subtract the annual exempt amount. So if I click on capital gains tax, there it is, 12,300 is 8,030. So the amount of capital gains tax payable. So it's relevant that she's got employment income of 45,500. But remember what we said in those earlier income tax questions. If this is her employment income, we need to take away the personal allowance here. So I'm going to do 45,500 subtract 12,500, which is 33,000 of taxable income, right? So 33,000, obviously, I'm not going to get that full 8,030 in before I hit my higher rate band. So if I'm on 33,000, obviously I've got 4,500 available before I hit the higher rate. So the first 4,500 of this 8,030 will be at 10%. Yeah, remember you've got the basic rate 10% and then everything else at 20% for capital gains tax. So I'm going to do 4,500 at 10%. And then I need to go, right, 8,030, I've done 4,500. So the excess is 3,530, which needs to be taxed at that higher rate of 20%. All right, so 20% on 3,530 is 706. Add that on to your 4,500 at 10%, which was 450. Gives you an answer of 1156. That is tricky. All right, but hopefully you see what I've done there. Right, true or false? Taxpayers will have to pay their 2021 capital gains tax by 31st January 2021. Well, clearly not, because that wouldn't even be the end of the tax year. It would be 31st January 2022. Additional and higher rate taxpayers pay the same percentage of capital gains tax. Yes, they both pay 20%. We just saw that. Right, Thomas has had the following capital gains and losses in the last few years. He wishes to relieve his losses at the earliest opportunity. Right, so I'll sort of work this through then. So 1819, he's got 26,500 of gains, subtract 15,700 of losses, comes to 10,800, and then he would use 10,800 of that annual exempt amount and just lose some. So nothing to carry forward from 1819. In 1920, we do 31,800, subtract 46,500. I'm on negative, or loss of 14,700. So we do waste our annual exempt amount that year, but we can carry forward this loss of 14,700. All right, so make a note of that 14,700 loss that you have available. In the current year, if we do 46,300, subtract 27,500, we get 18,800. Now we know it is most beneficial to use all of the annual exempt amount before we touch the losses that we have brought forward. So I'm going to subtract the 12,300, which leaves me with a gain of 6,500. So how much loss did we have? I'll write that down somewhere. I had 14,700 of loss available. So I'm going to wipe out this 6,500 with some of that loss brought forward. So the answer to that first bit there is that there's going to be no capital gains tax because I was down to 6,500. I'm now going to use some of my available loss to bring it down to nil. The amount of losses, if any, carried forward. So I had 14,700. I've just used 6,500. So the difference, the amount that I've got left to carry forward is 8,200. Right, that's it for capital gains taxes. So now we are on to the inheritance tax questions. So remember, the first of these is a computer mark question, which I don't generally think is too bad, but I'm not doing the actual exam, so there we go. Right, Mabel, 95, lives in the UK, made a number of gifts to her granddaughter in recent years. These are the only gifts Mabel has made. That is important because of the annual exempt amount. Complete the table to show whether each of these is a chargeable lifetime transfer. Well, none of them are going to be a chargeable lifetime transfer because none of them mention the word trust. They're all gifts to her granddaughter, so none of them are going to be a CLT. An exempt transfer just means it's categorically exempt because maybe we've used some of our lifetime exemptions. Because at this point we don't know how long Mabel is going to live. She's already 95. If it's a potentially exempt transfer, means that there's some tax implication if Mabel dies within the next 7 years. Right, so May 18, so that's in the tax year 1819. So we could use some of our annual exempt amount here for that year, making that one exempt. So that's in the tax year 1819. So that's that year done. We can carry forward £1,000 of annual exempt amount from that tax year, and well, no, we would have lost the previous year's one by then, wouldn't we? So then we're into 1920. So we've got a gift of 7,000. So we can subtract this year's annual exempt amount and the remaining 1,000 from last year. But that still leaves us with £3,000 here, which makes it potentially exempt only if Mabel survives 7 years from the date of the gift. 10th of July, so we're still in the tax year 1920. Oh, it's a wedding gift. I'm pretty sure. Where are we? Inheritance tax. Pretty sure 2,500 is the grandparent amount, but let's just check. Yeah, grandparent 2,500. So that will apply there, the marriage exemption. So that will become exempt, whatever happens. Right, 30th of August 2020. So we're now in the tax year 2021. Gosh, she's given away a holiday home in Spain. So can only use some annual exempt amounts which aren't going to really touch that. We do, oh, actually it is relevant though, because we're in the tax year 2021. So we have to use our annual exempt amounts in chronological order. So we'd used one here, hadn't we, 1920 against this cash gift. We're now in 2021, so we knock our 3,000 off of this. It's still potentially exempt because obviously 41 take away 3,000 leaves something. But the more important implication is that this gift, which you might have thought, oh, I can wipe that out with the 3,000. No, you can't, because you've already used the 3,000 on this chronologically earlier item, which means that there's nothing available as an exemption for this cash gift for her birthday. So that is also a potentially exempt transfer, not exempt. And then in the same tax year, family jewellery, where we've used up all our annual exempt amounts, doesn't matter what it is, potentially exempt. Okay, so key rules there around that annual exemption, that you can only bring forward from one previous year and that you have to use it in chronological order as the gifts arise. Right, task 13. Stanley, who has never been married, died on the 10th of June 2020, leaving an estate 300,000 to his brother. This included a residential property. Right, so you might be thinking, oh, residential property, residence nil rate band. No, because it hasn't been left to a descendant. Right, it's only if a residential property is left to a child or a grandchild that you are allowed to use the 175,000 per person if you're married. He's not married either, so there is no residence nil rate band available here. The only gift he made was to a friend, Emily. The gift, a house, crikey, was made on the 22nd of December 13, when it was valued at 341,000. Right, has he that would have been a potentially exempt transfer. It wasn't into a trust. Has he survived it by 7 years? December 13, 14, 15, 16, 17, 18, 19. Oh my goodness, he's missed out by what? Just over 6 months, and it would have all been exempt. But don't forget, we've got taper relief, so he's done between 6 and 7 years. So Emily sort of done all right there. So what we asked, calculate the inheritance tax payable by Emily on Stanley's gift at the time of his death. Enter your answer and workings into the blank table below, blah, 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 blah. Right, okay, so I'm going to use that as a pound sign. So make sure you read the question carefully. Payable on by Emily. So we're not worried about the death estate, we're worried about the gift. So, house. Value. I suppose we could put the date. So 341,000. So remember, when you're doing tax on something sort of triggered by someone's death, the gift was made during their lifetime, so it would qualify for the annual exempt amount at that time. And it says the only gift he made. So he would have had the current year annual exempt amount available and the prior year annual exempt amount available to reduce the chargeable transfer value of the house. So that would have been 135,000. Now we could call that the chargeable transfer. Right, so we then apply the nil rate band, which is 325,000, giving us 10,000 as the taxable amount. Right. Oh, said that they're giving me more room than I needed. It's not that much room, is there? Right, so I'm then going to work out the tax on that. So tax on death is going to be the 10,000 times 40%, which is £4,000. Paper relief, 6 to 7 years. Right, so remember taper relief is applied to the tax. So 4,000, if we look up here, 6 to 7 years gives us an 80% reduction. So 4,000 times 80% is 3,200. So the tax due will be 800. That's quite a nice question, actually. A bit of taper relief, yeah. Calculate the inheritance tax payable on Stanley's estate. Right, so the estate is 300,000. So we don't care that it includes this 185. What we do care about is that the nil rate band has had to be used against this chargeable transfer. So the estate value is 300,000. No nil rate band remaining. We've used it all on the gift to Emily. So the tax due will be 40% of the 300,000, which is 120,000. Yuck. Just think, if you just lived another 6 months, that 325,000, that would have become a potentially exempt transfer, and then that 325,000 would have reduced. He would have cancelled that out, and that whole 120,000 would have been saved. Seems a bit harsh, doesn't it? Anyway, it's not very cheerful. That is the end of the second AAT sample assessment. Hope you found it useful. Make sure you do lots of practice.